Podcast Network Asia. First Metrosec is providing this podcast as a general market commentary. Reference to any specific security, product, or entity do not constitute as an offer or a solicitation of an offer to buy or sell any financial instruments or to participate in any particular trading strategy. The statements, comments, views, or opinions expressed by the hosts are subject to change without notice, and First Metrosec is under no obligation to update, amend, change, or correct any of the statements, comments, views, or opinions expressed. The statements, comments, views, and opinions expressed by the guests are their own and do not necessarily reflect the view of First Metrosec. First Metrosec disclaims any liability arising from reliance on or reference to any information obtained in this podcast.
You are listening to First Metro Securities Philippine Stock Market Weekly Podcast, where we feature timely and relevant discussions on the Philippine stock market and the economy in the hope of providing you investing and trading guidance. Here's your host, Royce Aguilar, from the Research Department at First Metro Sec.
Hello everyone, welcome to another episode of First Metro Securities Philippine Stock Market Weekly. We have a special guest today, but before that, I would like to discuss the following. Of course, later we'll talk about our guest in terms of how he is helping a lot of small investors outperform this market, right? This type of market environment, diba, you outperform. How do you do that? Well, we have a lot of questions related to that. But since we're talking about how to outperform or how to imbibe or the best practices in this type of market, let's discuss the performance of the PSEI and each of the sectors, as well as the different global asset classes in the past 5 years. So when talking about Philippines, for example, this is as of end 2017 until end 2022, so basically 2018 to 2022, right? So if you take a look at the PSEI alone, it's down by actually 23% in the past 5 years, right? If you take a look at each sectors, it's distributed equally mostly, right? So you see the financials down by 26%, industrial 16%, holding firms 25%, property 26%, mining and oil just 6%. But if you take a look at the services, it's actually flat, specifically up by nearly 1%, right? If you take a look at the breakdown of the performance of the past 5 years, see ICT and Globe are actually up in the past 5 years as compared to the other names. If you take a look at the US markets, Dow Jones up by 34%, S&P up by 43%, and Nasdaq up by 51%. If you take a look at the EU, the Euro Stoxx 50 up by 8%. And across the other Asian markets, see Hong Kong down by 33%, Shanghai down by 6.5%, Korea down by 9.3%, and Nikkei, Japan's actually up by 14.6%. How about the other asset classes? Gold is actually up by 40%. In past 5 years. Oil is up by 32%. For coal, 300%. But keep in mind that the coal last 2022 ended the year at $400 no, average. But since then, it pulled back to 170 level. So if literally 2018 till now, mga around 70% down. If you take a look at nickel, up by 136%. Of course, for reference, Bitcoin up by 29%. If you add the 70% outperformance this year, approximately 100% up in the past 5 years, right? So now, let me introduce our guest. So he has 30 years of experience in economics, in industry and company analysis, valuation, portfolio construction and execution, and client management. Recognized long-term track record of #1 in the management of equity funds. He is also experienced in generating investment ideas, developing, formulating, and implementing strategies, managing risks, and remaining resilient when faced with poorly performing financial market, diba? Like right now. So just to mention some of his accomplishments, he was ranked #1 in the Philippines in categories 1, 3, 5 returns in actively managed equity mutual funds in terms of what he was managing at that time. And the 2010 return of the equity fund that he managed recorded 63% or much higher than the rise of the PSEI index of 37% for that year. So just to mention also, he was the equity portfolio manager for one of the largest institutional investors in the Philippines. Funds managed over 60 billion pesos plus lang naman. And he also authored the online journal blog decoding investments for the largest insurance company in the Philippines. He's also educated clients and client-facing advisors on investing in the Philippine stock market. He also headed the research department of one of the largest local brokerage in the Philippines. And he delivered forecasts in inflation, interest rates, and exchange rates for the country's leading economic think tank. So if you think we see the wide range of experience there. But let's talk about recently. So since August 2022, all investors that he helped are making money except this one portfolio lang na losing just hundreds of pesos. But if we take a look at the money weighted return of the worst performing portfolio, which started on March 1, 2023, the PSA was at 6,601, so 10% per annum as of March 17, 2023. The best performing, which was started on December 14, 2022, when the PSA was at 6,615, is 89% per annum. So for clarity, diba, kung money weighted, probably he'll elaborate later, but for money weighted return, it's an annualized return that indicates what investment would return over a period if the annual return were compounded. So currently, di ba, ang dami na experience ni Sir, but currently he's an independent investment advisor where he helps small investors in economics, di ba? Yun nga, as mentioned kanina, company valuation, industry analysis, right? So let me welcome to our episode Mr. Junie Banaag. Hey, hi, Sir Junie. Welcome to our podcast program, sir.
Hey Royce, hi. Thank you for the very warm and long intro. I hope we have time for the many questions that you have. And yes, I'm quite excited to be here. Thank you for the invite. Let's push on.
Let's get started. So thank you, Mr. Junie. So first question, as mentioned in the intro, remaining resilient when financial markets are performing poorly is one of your mission or teachings to the small investors. Can you elaborate on this?
Thanks for that question. And I like what you said there, mission or purpose. No? So let me define resilient this way. To me, it means achieving a positive investment return. Even when stock prices in general are down, you can't have a positive return if all stocks are down. So some of them are up, even if most of them are down. So over an acceptable period, you'd want your portfolio to be positive. Expectedly, in the short run, it's reasonable for investors to expect a loss. We know that at any point in time, stock prices are the result of supply and demand. Now, it's really as simple as that. Those who are selling stocks today, they probably believe that inflation will not fall very fast, or that the economy will slow in a big way. There's also momentum. So both these mood or expectations and momentum that in those influence demand and supply. And yes, it's important. Remaining resilient means making money over an acceptable period of time. And it's not you or me determines what acceptable is. We know that it's the investor who determines what is acceptable or not acceptable.
All right. So in the US, sir, follow-up question. In the US, for example, there are a lot more assets, diba, that are not correlated to equities that investors can use as a hedge. There's also shorting, so that when the market is trending downward, you can make money off it, right? So in the Philippines, how do you specifically remain resilient when financial markets are performing poorly? So go ahead, sir.
Right. Yes. Shorting. Yeah. It's going to be more complicated if we had shorting in the Philippines. So I'm not sure I welcome shorting. But for now, I think if you have a portfolio, and because there's no shorting, you could do it in a specific way. We should emphasize that before you invest, you need to know a lot of things, and I will enumerate them. So first, you need to know which companies earn out of their capital 15%. I say 15 because, as we know, if you have 15 or 14.8% a year, in 5 years, you'd be able to double their capital. And you'd hope that you're in a company who can double their capital sooner rather than later. We know that these companies have moats, quote unquote. It's not a new term. Around their incomes, they have a high barriers to entry. They have a sizable share of the market. probably the lowest cost of production, if not at least a very competitive cost of operation. And you have a high cost of switching. All these prevent others to get into the market, or it limits the competition. And importantly, these companies who have moats, they're able to increase their revenues without compromising their returns on invested capital, or ROIC. So this metric, return on invested capital, or ROIC, will be mentioning this very often. So we've observed that high ROICs are not always accompanied by positive investment returns. That's not always the case. However, we also know that companies with high ROICs, the simple definition or formula for ROIC is your net operating income after tax as a share to your operating assets. No?
Right.
So if you have a high ROIC, the more likely you create value than those companies with low ROIC. So it's a likelihood. So you want to be in good company. Hence, you want to prioritize or focus on companies with high ROIC. So that's the first. The second, and there are many things you need to know. The second being, you'd like companies who report rising operating incomes most of the time. In reality, not all companies, or it's not all the time that companies report rising operating incomes. But we know the operating incomes add value to their stocks. No? And especially if the incomes are greater than the cost of capital, the values of these stocks increase. No? Right. And inevitably, sooner or later, their market prices follow. Also noteworthy, if you have rising operating incomes, that will shorten the acceptable period of time, which we mentioned earlier. Investors want money sooner rather than later. So if we're saying that incomes follow, or rather stock prices follow incomes, then the more often operating incomes rise, the sooner stock prices will follow. So you have the third, you need to know which companies have cash left after paying the banks and reinvesting in working capital or fixed assets. We are common shareholders. When we buy stocks, as a common shareholder, we have the last priority over income. The first priority, that belongs to banks, bondholders, and preferred shareholders. They have the priority. Fourth, you need to know which stocks are trading below or above their intrinsic or monetary value. This is not easy. That's the simple reason is not everyone, and probably it's only a minority who would have an estimate of the monetary value of a stock. Why do we need that number? Simply put, you need to know what you are buying or selling. If you don't, the seller from whom you are buying from, or the buyer to whom you are selling to, he may have an advantage over the price at which you are buying or selling. And then last but not least, you need to know which benchmark is appropriate. If your investment objective is to make money, and I suppose that is the investment objective of everyone, the appropriate benchmark is that which is positive all the time. And you probably know that already. That can only be inflation or interest from fixed income instruments, whichever is higher.
Got it. Thank you, Sir Junie. So a lot to actually get from that answer alone, right?
Yes.
So
I
first,
must
you need to
admit.
know which companies earn out of their capital 15% every year. Dapat mag-double in 5 years, right?
Yes.
Tapos second, rising operating income. Because for a lot of investors, they're looking at the headlines. Like headlines sa mga news.
Yes.
So net income lang yun usually. So what Sir Junie said is rising operating income. And then third, you need to know which companies have cash left after paying the banks. Kasi as a common shareholder, we're the last priority.
Mm-hmm.
And then fourth, trading below or above their intrinsic monetary value. And then lastly, you need to know which benchmark is appropriate. This is actually important because diba, a lot of investors are basing sa PSEI or a loan, diba? So at the end of the day, positive yung goal. So Next question, sir. In all things in life, to be able to succeed, the preparation is key. So I would like to ask you how you prepare before executing a trade. Do you have any to-do list or things you must know before you put money into a specific asset?
Right. Yes. Preparation before taking risks. Remember, when you're buying stock, you are actually taking risk. It's a small risk if it's a small money and it doesn't, alter or influence your lifestyle. But you want to make money just the same. So yes, I have a to-do list. I don't have it in front of me. Probably through the years, I've as you have said, imbibed it already. But before I share this, please allow me to add to my long answer to your previous question of what you should know. No? So to put more flesh into the answer to the first question, or rather the previous question, you should know that of the 285 stocks that trade at the PSE, only 9 companies report ROICs of at least 15% year in and year out. No? That's not a lot. And it would be a better operating or investing environment if you had more than 9. No? And then of the 9, 8 recorded positive investment returns in the last 5 years. As you mentioned, it's not been a good 5 years for us. On a per annum basis, that loss that you mentioned translates to about 4% a year for all shares at the PSE. So 8 of these 9 companies recorded positive investment returns. No? The additional info is that the ROICs of companies at the PSE is just 4.2%. And then you should know that there are only 20 companies whose operating incomes grow 75% of the time. You should know that there are as many as 40 companies that need to pay interest above or greater than operating income, or not financially healthy. No? And then you should know that there are offer prices. These offer prices at the PSE, 6 out of every 7 are higher than how much is needed to capitalize, quote unquote, or fund the company's operations, meaning you're actually buying them at a premium. No?
Right.
As a secondary, or rather buying common shares from the market, it's a secondary market. The shares got there through an IPO. You're taking over the capital of someone who had that capital before you bought it. He may have bought it at a lower price. But now you're buying it at a price that, because it's higher, it's a premium because the company doesn't need that much money to fund its operations. Or for most of the time, you're actually buying it higher than the book value or net
Right.
worth of the company.
Correct.
So to answer your question, the list includes the following. It's probably, the list can lengthen, but it cannot shorten. No? But it should include 1, invest in companies that are likely to create value. Stock prices rise as value is enhanced or increases. No? So you can't expect stock prices to go up if the values are stagnant or are reducing. Number 2, invest in companies whose operating incomes are likely to rise. So again, you want to shorten your holding period, even if you are getting in there and assuming that you'll need to be there for the next 3 years at least. 3, invest in companies where there will be cash left for the common shareholder. This is rather easy, a metric to access. One metric could be your interest cover, or
Yes.
so that's easy to find. And then 4th, invest in companies where the intrinsic values are higher than their market prices. Yep.
All right. So I think you mentioned this earlier. Do you have any strict rules that you follow in terms of stocks invest on, such as, besides yung earnings that you mentioned earlier, like management, companies who prioritize ESG and the like?
Yeah. Yes, you could say there are strict rules that I follow. So what I know about stock markets, how they work and how they don't work, that has helped formulate these rules. It's likewise important to be aware that if one decides not to follow this rule, the risk is higher. They are strict rules because they put boundaries within which you want to operate. If you want to operate outside of that boundary, you simply need to be aware that you are taking on a higher risk. So you mentioned in relation to earnings, these need not grow double digit per annum if they are growing fast enough and creating value. So one simple example would be if interest rates are falling, even if earnings are rising less than double digit, it helps already that the cost of capital is falling. Hence, the value of the stock is rising. So it doesn't need to be double digit, but yeah, we'd love double digits. And then reputable management, yeah, that's a must. Credibility, belief of the market and management. We've seen that in companies that have been, sold to other shareholders, and now they're doing very well because the new shareholder appears to be reputable. And then finally, companies need not prioritize ESG. I have nothing against ESG. So need not prioritize that one. If doing so will destroy rather than create value.
Understood. Understood. That makes sense. Next question, sir, is I understand that those part of a big fund management firm, the Badisha, Bloomberg terminals, etc., where yung updated data are well consolidated. So for those investors who don't have that type of technology at their disposal, how do you filter information? Where do you recommend they look for data? Do you have data sources that you recommend to small investors? Go ahead.
Right. Yeah. So my go-to data is Bloomberg, not for any special reason. I've worked with Bloomberg for a very, very long time, and hence having seen the depth of the information there, it has helped a lot. That is my go-to source, and I would recommend all investors to go to Bloomberg. You may be able to filter the same information without Bloomberg. That's quite possible. But the buyer or seller who has access to Bloomberg, I think, may be able to filter faster or more efficiently than you can.
Great. Thank you for that, no? So, grabe talaga if you use Bloomberg, no? So, for our listeners who want to be exposed to other than local equities, how would you advise them to allocate their investment? So, perhaps you can mention your preferred allocation among local foreign equities, local foreign bonds. 60-40 allocation between stocks and bonds has been the norm. Is it still applicable nowadays, or does it depend on per investor appetite and the age of the investor?
Yeah, you have to be confident about the prospects of the stocks that you invest in. So I'm for the stocks that I suggest, I'm confident about them. Over time, investors in high ROIC companies, I think, will achieve returns that approximate the ROIC themselves. So if it's 15 or 20%, I think over time, that's going to be the investment return that investors will enjoy. So, you talk about yields from bonds. I think they are what they are. But if I consider the resiliency of the stocks that I advise investors to invest in, I would advise as much as 100% investing in local stocks. I like the depth and breadth of the US stock market. There are much more number of companies in the US where the ROIC is higher than 15%. But I find most of them, probably 99% of them, expensive already. I guess the result of a quantitative easing that's been going on for many, many years. The outlook there is less inviting than the local stock market, I think. Not everyone needs to agree with that. But I think the local market is looking better these days. So as a rule, the lower the risk appetite or the more advanced in age, the less one should invest in stocks. No? So yes, this rule still applies.
Got it. Thank you. Thank you for that. I think you mentioned this on the first question already, but I would like to probably emphasize your answer here. So how do you best gauge if one investor is successful in terms of performance? Do you have to beat inflation, perhaps a local index as a benchmark?
We must emphasize this. And to me, at times, it's surprising that the current benchmark or the most popular or what appears to be the more important benchmark is still used by many investors. No? But then we should remember that if the investment objective is to achieve a positive investment return, I think the better gauge, as mentioned, is the higher of inflation or yields from fixed income securities. No? Simply because it's advisable to avoid using a poorly performing index as one's benchmark.
All right. Hey, this question is interesting. The next one is interesting because a lot of our clients our clients are diverse. A lot of conservative investor and they're these aggressive traders.
Mm.
And I would like to ask, how much do you utilize technical analysis before buying or selling a stock in your 30 years of experience? Do you utilize technical analysis? Go ahead, sir.
Right. Yeah. It is interesting and in fact very relevant. No? I find that most investors, it is always the case. It is always happening. Practically everyone you speak to, your friend and other people, no, they use technical analysis. No, and yes, I do. Rather, I use technical analysis also. It's part of my to-do list. I think a to-do list should include trying to know what price most buyers and sellers are willing to buy or sell a stock. No, it's really where supply equals demand. No, I think that's the use of monitoring and watching and figuring out where the price will go in the short term, perhaps. So yes, I use technical analysis to know what users of technical analysis are seeing or incorporating into their decision making. Yes,
Right.
technical analysis certainly helps.
Got it. So this is our last question, and perhaps a lot of our investors, even traders, are interested on your preference at this kind of environment. So to specify the question, do you have any sector picks at this kind of market environment?
If I were to refer to the stock portfolios where I help, I see broadcasting, banking, financial exchange and data, distillers and vintners, and marine and port stocks. In reality, these are not the result of picking or liking these sectors where they belong. It's a result of satisfying my long to-do list, which we elaborated earlier, where we considered the ROICs of each company and selected those companies with high ROIC. We set aside those companies with low ROICs. It's quite a limited universe, perhaps, I must admit. But yes, in other words, I don't pick sectors. I pick companies with moats around their incomes, to emphasize that.
Got it.
And any company, even if the universe is small, I can live with that. That can satisfy our objective of generating positive returns over an acceptable period, and hopefully beat the benchmark of higher inflation and yields from fixed income securities.
All right. So thank you, Mr. Junie Banaag. Right, a lot of wisdom shared in a short amount of time. I'm sure our clients or listeners appreciate that. So, do you have any last
Yeah,
message to
thanks.
our
Yeah,
listeners?
I
Mr.
feel
Junie?
grateful with this invite, Royce. And the topic of our discussion is very, very interesting, especially in the kind of market that we have. Thanks to First Metro Securities, you've allowed me to share
Correct.
my thoughts on investing. And I'm actually thrilled at the prospect of investors using what they now know and succeed in their investments. Thank you.
Thank you, Mr. Junie Banaag. And this has been Royce Aguilar, Department Head of Retail research in First Metro Securities. As always, in First Metro Securities, it's hashtag your future first. So thank you, everyone. Have a great day.
Thanks for listening to First Metro Securities Philippine Stock Market Weekly podcast. Don't forget to follow us to get first dibs on our new episodes. For more up-to-date market news and info, exclusive content, and the opportunity to connect with your fellow Filipino investors and traders, join facebook.com/groups/FirstMetroSec and be part of the First MetroSec family.
The views and opinions expressed by the podcast creators, hosts, and guests do not necessarily reflect the official policy and position of Podcast Network Asia, the hosts of the program, or other programs of the network. Any content provided by the people on the podcast are of their own opinion and are not intended to malign any religion, ethnic group, club, organization, company, individual, or anyone or anything.